Markets in turmoil as a jobs number come out, showing a pretty bad economy, all things considered. And all eyes are on the Fed's decision later on this month. All that and more on today's After Hours. Welcome to After Hours at Trader Suppose for Friday, September 5th, 2025. I'm Tom Hartman, joined tonight by Peter. The madness. After Hours is your go-to live stream for sharp, trader-focused market commentary presented by Trader Suppose, the ultimate advanced trade execution platform in the universe. But more on that later. For now, Peter, the jobs numbers have been rocking markets. Were you paying attention to price action live today where the market moved up and then down dramatically?
Yes.
So what's interesting about this is that sometimes you get a leak of the information beforehand. Some people, powers that be, people in the know, they have a sense of what that number is going to be and how the markets might react, and they can then front run that. And so when we saw this march up from last night, from yesterday, from the lows that Mike Christensen on Price Action Live was calling for, all the way up, we just marched up. It was pretty brutal, portending, hey, we're going to have an explosively up day today. But that didn't exactly happen, and the markets came down. All because of jobs, Peter. All because of jobs. Before we get to there, because we're going to talk a lot about jobs and recession and the Fed cuts potentially this month and all the money you can make on that and what kind of bets are there. It's very, very juicy. I love that sort of information. First, I want to touch on the big macro points that we love to touch on here every week on After Hours, starting off with the dollar. So the dollar has decided to be weird. I'm going to say it. Decided to be weird. Normally, we like the dollar. Term? Yeah, exactly. The technical term is flat, which is not what you expect for the dollar. The dollar is usually trending up or the dollar is trending downwards. That's usually what we see. Mm-hmm. And what we're getting now is this sideways chop right within this crucial level. So you guys will remember, we've talked about before, the dollar, we could take a look at the DXY. I often look at the DX futures in order to get volume information. To me, it matters a lot what the volume is. The dollar is in between these key levels. So the dollar broke below 100 on the DXY, and it's been floating about between 100 and 96. And what's interesting here is that we're consolidating in what appears to be a bear flag here, right? Which generally suggests that the dollar will fall dramatically. All right, that the trend will continue and the dollar will fall. But we haven't been seeing that. Instead, what we've been seeing is the dollar moving sideways now since essentially July 1st, 2025. Actually, if you want to count it, it's since we got into this range back in April, which is right on the heels of the whole Trump tariff fiasco taco trade. Right, so we've basically been sideways with the dollar, which makes it hard to decide what you want to do with Bitcoin, what you want to do with equities, and all that sort of thing.
Right.
Today, I woke up today and the dollar, yesterday the dollar was up. And I was like, oh no. That's how I was feeling consolidation. When I'm in a consolidation and the price moves up, I go, it's going to go up forever. And when it's going to go down, I go, it's going to go down forever. And so today, it gave up all the gains from yesterday and actually made a new low over the last month. All because the dollar is being sold off, right? So the idea here is that with the jobs numbers that appear bad, the idea is, hey, we're going to have the Fed cut rates, which means get rid of those dollars. Who needs those dollars? The dollar's going to go down. If the Fed's going to cut rates and going to be printing money and QE and the whole thing, who needs to hold on to dollars to sell these dollars and buy equities, which was what we then saw in the overnight for equities. If you take a look at the Nasdaq overnight, I mean, over the last few days, it just from the lows over here just marched up. The Nasdaq moved up something like 3.5 percentage points, which is significant given the fact that just on September 1st, we thought things were going to be headed down. So the fact that the dollar fell today and made a new low suggests, hey, we're going to get Fed cuts and the dollar's going to go lower. And if the dollar goes lower, we all know, buy equities, buy Bitcoin. That's for the dollar. All right.
For the jobs, was that expected to affect the XY?
Well, yes. Any macro thing, especially for the United States, is going to affect the DXY. Anything that usually has to do with the West, I guess let's call it, United States and Europe, is going to affect the DXY because that's the type of asset that it is. And when institutional players or national sovereign players are dealing with the dollar, they're making long-term decisions, right? When these people are buying billions or trillions of dollars worth of the dollar or trading it volume-wise, you're dealing with decisions that are 6 months, 1 year, year and a half, 2 years long. That's why the trend in the dollar really matters, because it usually sticks. Very weird to see it just completely change directions within 3 months.
Awesome.
So now, as we pay attention to the dollar, we'll also turn our attention here to, well, let me just add on something there for the dollar. When we're talking about the dollar, we're also talking about bonds, all right? Because, Peter, you know that a dollar is basically the same thing, essentially the same thing as a bond, right?
Right.
Because the dollar is essentially a bond that has infinite duration. So the bond never gets called in, and zero interest rate, which is why people don't like dollars versus versus bonds. Why would you have infinite duration bond so you never get paid back from the borrower? Like, you lend out that money, you never get paid back for it, and you get no interest rate. It's like the worst of all things. Banks don't want cash. People want cash. They want assets. They want bonds. They want something that yields a return. So with the dollar falling, you're also seeing yields falling. And when, just a reminder for people, when bond yields go down, the value of the bonds go up, right? Because if you had a bond before that was giving you 4% interest, if you own a 4% interest bond that pays you out 4% interest on your coupon, and now bond yields go down, people will pay extra for your bond to get that 4%. They don't want the 3.5 one. They want your 4%. So your bond goes up in value. So bond yields go down, bonds go up in value, which means people are putting money into a safer asset that can yield a return instead of something else that they might do. All right. So bond yields are coming down lower, which has been pretty interesting. Here, we take a look at the short term. So the redder the color here, the more short term it is, and the bluer the color, the colder the color, the more long term it is. So we have short term rates just basically nosediving. We're down to I think 3.526% on the 2-year, and we are on the long term bonds on the 20-year, 30-year bonds. We're at 4.7%. So all the bonds across the board all came down, which is usually, I mean, bad for the economy, good if you own bonds. You know what I mean? It's one of those things where oftentimes bad things for regular human beings like ourselves and the economy are really good for certain types of assets. So bond yields going down is suggesting this dramatically is suggesting a problem within the economy. People are going, look, I need my money to be in safer things. Let me just go ahead and go into bonds in order to park my money there.
Can it?
That's on the heels of the jobs number being bad. The idea here is that people go, hey, if things are bad, when things are bad, move to safe haven assets. Go ahead, Pete.
So it's never just like a sentiment thing. It's definitely tied to something real.
It can be a sentiment thing. So when bond yields are going down, it's not always a safe haven play. In this case, it could be that with weaker jobs number, you expect lower inflation or even deflation, right? That's been the big concern over the last couple of years, inflationary numbers. And so, but you can only really get that inflation, like consumer inflation, if you have full employment, people have money in their pockets, they're spending, more money circulating around. And when you have more money, more amount of money chasing the same amount of goods, that's how you get price inflation, right? It makes sense. If I'm selling a product and you're the only one buying it, then we come to a price and you might say, okay, I get it for $10. If someone else comes and says, hey, I'll give you $12 for it, because they also have money, well, now you have to negotiate between the two and you guys might bid up the price for the thing. So I'd be like, well, if he's willing to buy it for 12, I'll sell it for 12. And if some other guy says, I'll give you 20, well, all of a sudden now prices will rise in order to meet that. That's inflationary effects when it comes from dollars circulating around. And so if more people are unemployed or not getting enough hours or have an expectation that they might be unemployed because of their sentiment, then there's less money circulating around in the system, which means you have lower prices and lower inflation. So if you lower inflation, if the bond yields were up because of inflation, right, there's a component of the interest rate for the bonds where it needs to beat out inflation to some degree. Otherwise, why are you lending this money? Like, that's the ideal. If the inflation's coming down, well, that premium then comes down as well. Awesome. So it might not be a flight to safety. It might just be inflationary concerns are not as high as they were before. Bond yields come down. All right. So bonds and the dollar are essentially the same thing, except that the dollar, you get a little bit more information because there's the other side of the dollar, which is all the other currencies. Whereas for bonds, you also have to look at bond yields in other countries, which we won't do today. All right. Equities. So it's been crazy. If you guys have been following on Price Action Live with me and Mike trading live, which you can do using Traders Pulse software, we just connect a bunch of prop firms together and leverage our wins across all these different prop firm accounts. It's pretty fun, pretty interesting, and a way of making money, more money with less risk. Head over to traderspulse.io to sign up for your trial today. But if you watch Price Action Live, you'll see that it's been pretty whipsawy, the price for equities. So we have here the Nasdaq on the screen, and it's been pretty choppy. We're normally used to the steady rise up, right, P? Markets only ever go up and to the right, and the goal is just find your dips to buy. But then we had here in July, the end of July, a big drop in the Nasdaq. And then it completely reversed to all-time highs, and then dropped again, and then rose to all-time highs, and then dropped again, and then rose. So when you have this sort of pattern, this is sometimes called a topping pattern. All right. So when you have bullishness that gets exhausted to the upside, you'll often get within equities this sort of like seesaw move because of the option space. All right, we're not going to go too detailed in that, but suffice to say, not only do people make money if the market goes up and down, and they bet it's going up and down, people also make money betting if it will in the future. Right? These are the option space, the derivative space, and there's all kinds of hedging that has to do there. There's all kinds of market participants that don't make money. Their way of making money isn't by betting if the market goes up and down. It's by selling options within the space. And so what happens is that as the market moves in one direction, they have an incentive to make the market move back in the other direction because they have to pay out less insurance. And so you have this sort of like reflexive move that the down in the market might make things go up and the upper market make things go down, but that only happens to a certain point. That gets exhausted, and when that gets exhausted, if you have the right catalyst, boom, you have the market that can go straight down in this top-end pattern. So that's the big question here in equities. Are we headed lower? Now, because we responded here to multiple levels here around the 6,300. Sorry, I'm on the wrong one. On Nasdaq, since we've been bouncing so dramatically off of this low here around 2,300, the question is the bad news done? Are we headed up? Not the bad news, but bad news for the markets, for financial markets. Is it done? Is the downside risk gone? And can we rush from over here? And the hope that everyone has, well, let's call it the CNBC, the mainstream has, is that rate cuts are going to come, Fed's going to be pumping money in, and markets going to make all-time highs. Everyone's going to be happy who's exposed to markets. That's what everyone wants. And the idea here is that, right, the worse the news is for the economy, the more the Fed needs to come in, right? Because the idea is that they are focused on stable prices and full employment. And so unemployment number goes up. Okay, good. The Fed has to come in and pour more heroin onto the markets. And people like us in the market space who like heroin, well, stick it in there. Let's just Breaking Bad this stuff.
Okay. Do you pour heroin? I don't know enough about heroin. Is it pourable?
I don't know how you do it. I have my own techniques. All right. So let's talk about Bitcoin here, because unlike equities that move dramatically with the option space for Bitcoin isn't nearly as robust. Right, it's not a huge amount of hedging and derivative contracts and all that stuff happening within the crypto space. One, because the asset moves so dramatically sometimes, right? Large percentage moves, and so you have to find someone who's willing to bet against Bitcoin doubling or falling by half, which happens all the time. In a bull market, even a bear market, 33 or 30% move on Bitcoin that happens is like totally normal. So. Yeah, good luck finding someone else who wants to take the other side of that bet. And so it's mostly perpetual futures and leverage long and short players that can move the market dramatically. Well, those are long-term plays. So if we take a look at the Bitcoin. Sorry, go ahead.
What about the ETFs and then the proxy companies like MicroStrategy or Strategy?
There's no transparency when it comes to the ETFs and the equity proxy plays for crypto, because we are not privy to how that settles at the end. It's not at the end of the day or at the end of the week. The ETF has a mandate to buy or sell a certain amount of Bitcoin, and they go and press a button for the market, and then it happens. There's all these machinations that happen where you have over the counter, so basically behind the scenes agreements to what they're buying and selling the assets for, and then whoever is stuck with that, with the mandate to buy and sell, they can divvy that up within the market however they, through whatever risk parameters that they have. So it can happen transparently to the market. It does obviously have an effect, but you can't just say, okay, because the ETF is not going to move dramatically versus the underlying, and so you don't get that much different in prices. What really matters is the long-term effects of the accumulation and distribution of the asset. So what happens is that Bitcoin becomes far more of a pure play on liquidity conditions, on credit conditions, on sentiment, right? Because you have some people are within Bitcoin because of the gold idea that it's a safe haven asset. Other people are within Bitcoin because if it's high performing, they're chasing that performance, either up or down. Other retailers, it's an easy asset for retailers to get into. So it's hard for you to go buy a share of Berkshire Hathaway, but it's easy for you to go buy $10 worth of Bitcoin. So it's,
and some people are doomsday preppers, and it's just, preparing for the economic collapse and needing something else. And there's still others who believe that maybe Bitcoin is an alien technology, and they're in the alien game by having Bitcoin. Tom, look, I gotta throw out those theories every once in a while now.
Sure. Don't forget that it is made from the Central Intelligence Agencies, one of them. What was it? Satoshi Nakamoto. Nakamoto means central. Satoshi means central intelligence, something like that. Yeah, I think that's what it is. Pull it up, Jamie. Just you'll let me know what it is. I think that's what it is. But whatever. It's like, oh, I don't want I don't want to buy Bitcoin because it's controlled by intelligence agencies and governments. Instead, I'm going to buy currency. Yeah.
Would
Yeah.
you rather it be controlled by the CIA or aliens?
CIA, MI6, Mossad, any of these
Are
places.
you
It's
like
fine
are
with
you
me.
like me? You're like the last thing we need is aliens to gum up the works and make things more
We can't.
complicated. I'd rather find out the Earth was flat than there be aliens. I'll tell you that.
Well, you're in luck.
Aliens that visit Earth. I mean, there's probably aliens that are out there in the universe. I mean, maybe, but aliens that visit Earth, I don't know. Sneaky aliens, because if we got to accept, I don't know why. I watch too much Joe Rogan. I'm in my Joe Rogan.
I don't want new neighbors. I have a problem if my neighbor changes. My whole life becomes topsy-turvy. I got an 18-month adjustment period for this. Aliens is going to be a whole thing. And how do you bet on aliens? I don't know how
What's the trade?
Yeah. What's the volatility adjustment there? Even if you're long vol, who's paying you out? You know what I mean? Sort of like that scene in Armageddon with the Steve Buscemi takes out $100,000 loan from a bookie,
Right.
and the bookie's like, "This is a lot of money. You sure you're gonna be you sure you're gonna be around to pay it back?" He goes and he says something like, "Well, I'll be around as long as you will."
Right.
I don't know. All right, so we have Bitcoin as a play on liquidity. And so what's been interesting with Bitcoin, we've been looking for it to bottom for a clip here, and it might have, right? If we take a look here on the daily for Bitcoin, this low here that we hit around 107 might in fact be the low. Now, if you remember, Peter, I've been talking about Bitcoin, that the low I was expecting, whenever you're in a bullish run, the low that you get for these pullbacks from Bitcoin is usually near the highs of the previous peak. And so the highs of the previous peak here was right here, 107, and right there it bounced. Plus, you have the whole thing of the the amount of leverage that's within the crypto space. If we take a quick look at Coinglass here, that is letting us know how long and shorts are levered long and shorts are positioned in Binance, OKX, and Bybit when it comes to so this is like a swath of the leverage players within crypto. You have here a high of around $19-20 billion worth of shorts versus 300 million longs. And this 300 million longs, it was 100 million just a couple of days ago. I think we talked about it. Just a couple of days ago, it was 100 million. So we got to pick up in the longs, but we have just as many shorts. We were at 20 billion short, and now we're like 19 billion short. And you essentially have about a 1% move that happens in markets when 1 billion worth of shorts get liquidated. There's about a 1% move up in markets, which means this move off the low, which is about 4%. I would only say 1% of those were from the shorts being liquidated, and 3% are coming in because people are actually becoming bullish, which would be pretty interesting.
I like the sound of that.
So we didn't quite get a high above the previous pivot high, which is over here of 113.5. We didn't get above that. Plus, this is that's a pretty bearish candle. Whenever you see a wick like this, it means that there was some pretty serious selling pressure, which is what we'd expect around this volume weighted average price level over here. So the question is, hey, what happens over this weekend, next week, or headed into quarterly OPEX for the end of the month? But with so much tinder of shorts waiting to get roasted, let's spit roast those bears. Let's send them back into hibernation. This is not their time. Let's send those scions off into space. It could be that we see let's say 15 billion of those shorts get liquidated and we get a 15% move up. Well, then, you're looking at 125, 130,000 on Bitcoin in a blink of an eye. In a blink of an eye, folks.
How much did you say?
150,000, 130, 150,000, anywhere in between there. So we'll see. And
Tom,
finally, now talking about
before we do that,
fiscal. Yeah, go ahead.
do you have any control over the crickets? Hey, everybody. My name is Peter Hartman, and I'm here to recommend Price Action live prop firm trading on Traders Post Tuesday, Wednesday, Thursday, and Friday. It's very exciting. It's very cool. You get to see the character of Tom Hartman and Mike Christensen. I didn't realize how interesting they were as people, the demons that fight within them. And you get to see that clash revealed live on Price Action Live. So I definitely recommend you like and subscribe and check that out. It happens many times during the week. So you don't have an excuse. And if you're out there trading, you definitely want to have a trading partners there with you. Maybe they'll inspire you to be your best self.
Peter wants to start trading. I could see it. I can read between the lines. Peter wants to participate. We'll get your other account, Peter. We'll get your prop firm account or two. All right, so we're going to end on here with this with fiscal and monetary policy, which will lead right into the big thing I want to talk today about jobs. So fiscal policy, that is what the government does in order to add in or take away money or credit from the economy. And then you have the monetary policy, which is what the central banks decide to do. Well, Peter, as we've all known, we've been following now for months now. I think even before Trump was president, what he wants is for rates to be cut. He's got it in his head.
I mean, it's funny because maybe I don't remember. I don't remember his first term. Maybe I don't remember it very clearly, but I didn't get this overwhelming sense from Donald Trump in his first term that what he cared about was these rates. But now, like every time I think about Donald Trump, I think about Jerome Powell. It's like more than anything.
Well, he's the one who put Jerome Powell into his position.
Oh, was it Trump?
Yeah, Trump did it.
Oh, interesting. And so why isn't Jerome Powell being loyal to the president?
And to the empire, exactly.
And to the empire.
Because he's a traitor, essentially. That's what he is. No, it's because he wants the Fed to be nonpartisan.
Right.
So I guess the way to be nonpartisan, just to at least appear that way, is to allow the economy to suffer, people lose their jobs, make it so clear that you do need to cut rates, that people go, well, finally he cut rates. He's really taking this nonpartisan thing really far.
There's a logic to that.
They have to do that.
Yeah,
because
they definitely have to. Yeah.
The alternative is that they don't. They cut it right away. Everyone thinks that the administration is one doing it, and all of a sudden they're the ones who have the reins to power.
Exactly. Which is why
go ahead.
I'm most confused why Donald Trump is like. I mean, there must be a reason behind it, but why he's so forceful in the public, pushing it. I think you gave me an answer to this. I can't remember what that was, but there is a logic to. Oh yes, Was Donald Trump trying to do his version of forward guidance?
Yeah, him and Besant. Yeah, Besant. Right. He wanted to be so forceful. You'd imagine this would be the 4D chess of going about it. The 2D chess is that he just thinks, I wanna, and he wants to lower rates. Fine. The 4D chess version is that he knows that Powell can't be like, okay, right. I'll cut rates, Trump. Right. So that there's always going to be a speed bump within the financial markets because of tariffs, because of what's going on in the economy, and then they could blame this on Powell, on the Fed. Now, leaning into that, we have the whole thing where basically the Trump administration is basically going after the Fed. I've never seen an administration go after the Fed members so hardcore, right? So the idea here is that there are voting members within the Fed. It's not just Jerome Powell speaking and making a decision, even though I think that's exactly what it is, but whatever. The idea is that there's council who are voting, and sometimes they made a decision, but 3 people dissented and 2 people thought we should do something else or whatever. Some people speak out, some people don't. So it's one of those ways that the Fed uses to mitigate what they're saying. it's also a political game. It's like, well, we wanted to cut rates because we think that people have suffered enough, and they go, no, we don't think people have suffered enough. And so there's a game there. So part of that game, it looks like Trump's going after the Fed chairs.
Yeah.
It'd be a shame if your daughter couldn't go to that private school anymore. Maybe public school. I hear they're really good. I hear the public schools are really good. No, we have.
But he's trying to. Right? He's firing. Yeah, he's firing one of them for mortgage allegedly.
No. He's not firing them. He can't fire them. What he's doing is prosecuting, which is worse. Fire me. Don't prosecute me. And so we have the situation where basically, Game of Thrones level wise, he's causing Fed chairs to flip their vote to cut, right? To the point where if he gets enough of those votes, well, they have to go ahead and cut. So I thought it might be fun. Obviously, I'm no expert on the Fed, but there is an expert on the Fed that I like to pay attention to. Her name is Danielle DiMartino Booth. So let's just hear what she has to say about this. This is an interview from 9 days ago where she talks about this whole Lisa Cook affair. Pay very close attention to this idea of the 4D chess of how Trump is doing this Machiavellian thing in order to get the rate cuts that he so richly deserves.
The market implications here. I mean, does this say to you overreach? How dangerous is this kind of move?
The move he's talking about is prosecuting the Fed chair for whatever, mortgage fraud or whatever. Seems quaint for Trump, who went through this whole thing with the real estate.
I have a feeling.
I have a feeling
they're all do. I think all of them do this mortgage thing allegedly. I think they all do it.
They should get their money where they need to get their money. I mean, they don't get paid enough at work. You got to find your way. To find your money elsewhere. All right, we'll see.
Well, when you consider the number of individuals, the two dissents, Michelle Bowman, Christopher Waller from the July FOMC meeting, the fact that there's another nominee who could get really confirmed before the Fed next meets in mid-September, and now a potential fourth individual to the Federal Reserve Board. You're talking about a majority here, potentially, again, of 4-3 on that 7-member Board of Governors. I can't overemphasize enough the import of this, because it's not just sway over the Federal Reserve Board, but indeed individuals who run the district banks around the United States of America. The Board of Governors has to sign off on each individual before they are appointed in each of the individual 12 districts. So this could carry deep, deep significance in terms of the ability of President Trump to theoretically stack the Federal Reserve and the Federal Open Market Committee.
Well, let's say.
Boom. I nominate Senator Palpatine as Emperor. I mean, you asked me, hey, how would you go about, let's say you couldn't make the Fed do what it needed to do. Like, what would you do in order to make them do what you needed to do? Oh, man, I turned the screws behind in order to make sure that they all flip one by one by one by one. And if you are, this is what I'm thinking, if you are Jerome Powell, you can't fail, right? You can't be like, well, I got totally overrun, totally outvoted. Like, Jerome Powell can't be the dissent in vote. You know what I mean? He can't be like, well, they voted to cut rates, but Powell, they don't want to. Like, that can't happen. So that's why I think you get the Jackson Hole thing. He sees right on the wall. He goes, I better change now, because if they get everybody else, well, I got to change then too. And that'll be way more embarrassing. And then it'll just prove that the administration has control, has forward guidance. And then, who needs Powell anymore? And then he'll lose his job and the whole thing. Like, why? Might as well turn coat right now. So that's what I'm thinking is the first part, that since the dominoes are falling, we're to get these rate cuts. Now, the question I have, we're here to figure out what bets to put on. Well, like, where's the money? Where can we make money on this? And as you know, for retail traders, I love Polymarket and Kalshi and all those things, all those beta markets. And the beta markets right now are indicating that there's an 88% chance for the Fed to cut 25 basis points. Right?
25.
Yes. Now, if you're Papa Trump, all hail Trump, may he live forever. If you probably don't want 25 basis points, you probably want just cut 2%. Let's just cut 2% now.
Right.
So they're not going to do that. So maybe, this even uptick now. This was 9% beforehand. So this 50 basis point cut, if we get that in what, 2 semanas here coming up, if we get that on the 17th, one more time.
Just my OCD, that hide at the bottom there. Yeah, you were saying?
Yeah, if you if we get a if this is happening because Trump wants this to happen, then maybe we just go ahead and get the full 50 basis point. Right? Maybe we get that cut. And if you do that, right now, if you take that bet, you make 100 makes you 1,000. Right? $100 gives you $1,000, which is 10x return. Look it. If you can go find 10x returns elsewhere, you go get that. If you can get 10x return on a bet between now and the 17th of September, you go ahead and do it. If you don't, put down the sushi menu and just give it a shot, because $1,000 in, you're sitting on $10,000 because of a $1,000 bet. That's pretty sweet.
Not financial advice. Do your own research.
Yeah, your kids don't need a college tuition. What they need is to be set for life. You want them to make enough money so that they don't even need to go to college. You need a trust fund kid, and you're not going to get there just by your 401k. Come on.
You might.
Not financial advice. Do your own research. Okay. So, but you could even bet just on the 25% increase, and even now you'll still make 10% on that. A little bit more than 10%. That's pretty good. Of course, you lose it all if they actually do 50 basis point. So you might as well do the 50 basis point bet. What are you trying to nickel and dime here to make 10%? Keep your money instead. Go buy a bond for 5%. There. Go buy a bond for 5%. You don't have to do any of this, and you're guaranteed your money back. So the markets are pricing in a, like I said, an 88% chance. Actually, it's a little bit more than that for the probability of a Fed cut. Oh, it jumped up to 91.8. It was at 80 something beforehand. Oh, that's why the 50 basis point cut went up, because the odds of a cut have increased. Now, why has this happened? Well, that's because of the jobs number. So we will dive into that. We're going to look at all these numbers, but before we do, a quick word from our sponsors.
Ask yourself this: are you making trading harder than it needs to be? If you're trading manually or still coding just to connect to your broker, yeah, it's time to upgrade. Traders Post lets you automate trades using signals from tools like TradingView or TrendSpider, or even your own custom setup. It works with brokers like TradeStation, Tradeovate, Coinbase, and a bunch more. I've been using it myself, and getting started was smooth. The platform's clean, setup's quick, and once it's running, it just works. And when you're ready to scale, adding more strategies, plugging into prop firm accounts, or juggling multiple portfolios, Traders Post handles it. It's built to grow with you. Start your free trial at traderspost.io. Trade smarter, automate your edge.
I wonder if Traders Post will ever have like Bitcoin within their treasury. All right, so the jobs numbers. So all the reports that come out for the Fed, I don't care about all of them. I care about a certain set of them. I care about what moves markets, certainly. But catching a long-term trend at the turn is one of the most lucrative things you can actually do. All right? So just to be aware, you think it's great to make a bet that makes you, 10x, 100x by betting, over the next few weeks, month, or whatever. You can have 1,000x bet on options that pay out just massively if you're right. Or the stability of your money, if you're right on a turn, let's say you're right that we're headed into fiscal problems and you put your money into gold, well, you're laughing now because gold is just rising and rising and rising and rising and rising and rising and rising, and you have to trade in and out of it, in and out of it. So these macro trends are very useful, one, for the volatility in any given day when the reports come out, but also helps to set your mental framework for how to invest long term, all right, or where your bias will be trend wise. Employment numbers, because it's one of the main mandates of the Fed, right? Stable prices and full employment. When these numbers move, and they move very slowly, employment numbers move very slowly, it means that ice is cracking right now. All right? Just keep in mind, when you're dealing with unemployment numbers, if some company is going to lay off 10% of their staff, it's usually the last thing they want to do. Because all the effort it takes to find people, then to get them in, train them, have them part of the culture, have their whole lives reorganized for that sort of thing, to fire them, like you'll start bleeding money a bit before you even do that. Better to see if you could find a way of keeping them through a recession, a downturn, than to go through the whole process again. It just costs too much. Plus, then you have the whole churn within the company, knowledge gets lost. It's a whole messy problem in order to do that. Just think of, nope, I was going to make a crash joke. Let's just keep it above board. This is the internet. Things live for posterity. But you want to make sure that you don't want to just like flip the table on these things. And so people, they'll cut corners on products. Companies will pull back on CapEx. They'll do all kinds of things before they let people go. So once that starts to happen, it means we are right on the verge. So we've had here average hourly earnings year over year that went down by 0.2%. So it was previous is 3.9%, actual is 3.7%. That means the number of hours, paid hours that people are working has decreased. Not a huge drop, but it's the beginning of a trend. We have non-farm payroll that came in at 22,000 versus 79,000 previously, and 75,000 expected. Can you imagine that? They expected non-farm payroll to go up, to stay around the 70,000 handle, and it dropped massively. Right? Dropped by 66%. So that means the jobs are just way worse than we think. The participation rate ticked up. Participation rate, that's just the rate at which people are trying to get a job. So if participation is going up, and including here for unemployment, we'll see here for a second, unemployment rate also went up from 4.2 to 4.3. That means there are more people looking for jobs than there are jobs available. Also bad. Because there's sometimes a case to be made that people aren't looking for jobs. I think we had that during the lockdown. People were getting money elsewhere. They weren't looking for jobs. And so they have to try to find a way of forcing people back into the job market. But this is not that case. There's more people looking for jobs than there are jobs. So you have the non-farm payroll that came in way under expectation. Private non-farm payroll also came in far under expectation. Non-farm just means like, because these reports were back in the day when farmers were more of a thing. And so you wanted to have jobs that don't include farming. It also doesn't include government and a bunch of other auxiliary jobs. So there's really like the core job market. So that's worse than it was before. Unemployment rate ticked up. Now for the unemployment rate to go from 4.2 to 4.3, I know it doesn't seem like a lot, right? Going from, a 0.1% difference might not seem like a lot. But if we take a look here, when you take a look at the unemployment rate, just understand that recessions happen. One of the last signals for recession is that unemployment rate goes up, right? So this is the 2008 crash or crisis, the global financial crisis. Here it's the COVID. Here you have the .com. This is the unemployment rate that we're seeing on the screen. And when it starts to move upwards, we're basically on the door of recession. We're essentially on the door of recession, right? So if we zoom in here just a little bit closer so you can see, right? So here we have a bottom. This is before the global financial crisis. And when it starts to tick up, that's where you need to pay attention. It's when it just starts to tick up to make higher highs. That's when you have to start paying attention. Because soon after that is where all hell breaks loose and your puts cost so much money and you've lost 20% of your assets and all that sort of thing. So here we we're at 4.3%, which is the highest high we've had since October 2021. So we just ticked into a new high. So if we're in this process where we're going to be making this is going to ramp up, well then recession's on the door. Hell, we might even be in a recession already. Who knows? Because the low that we had over here from 2022, 2023 was at 3.4%, and we're up since there. The only reason we haven't called a recession yet was that we had this, it went sideways to down a little bit, but now it's making a higher high. So unemployment rate, jobs numbers, extremely important, right? We talk about initial jobless claims, continuous claims. All those are earlier in the chain of the jobs market. But when we get to unemployment rate, buck stops there. If that starts going up, problems. And the Fed can't ignore this sort of data. On top of that, Peter, on top of that, we have an issue where, let me pull this up 1 second.
But wait, there's more.
That's right. So we have an issue here. Can you see my screen?
Yep.
Where the jobs numbers in June were revised lower.
Of course they were.
So remember we talked about last time, I think last week we talked about it, how the 2024 numbers were off by 818,000 jobs. There was actually 818,000 jobs less than what they said. Now, keep in mind, that's after a year of revisions anyway. They put out the number, a month or two later, they revised the number from beforehand, and then at the end of the year, they revise it again. So the numbers get revised usually lower, and then at the end of the year, it's even lower still. So it came out that the revised numbers for June was that there was actually 27,000 less jobs than what was reported. So it looked like there was a net positive jobs in June, July, but it turns out it's a net negative of jobs. That means the slowdown in the jobs market happened way earlier. Because by the time the unemployment rate shows up, it's already too late. So that the Fed should have been cutting beforehand, which means if they're going to cut, Peter, we didn't even get a report that they cut now. The idea is they might cut in 2 weeks, right? And it'll take months before things take effect. So usually, this is the point I'm going to end on here. Usually, when the Fed cuts, it coincides with downdraft in markets. Right? Bad news in markets. Because it usually means something bad has happened. But what if, so the question is, what if we're actually already in recession? And the bad things that were going to happen was actually from the dip that we normally get when the Fed cuts rates initially was from March to now. And that we already had the first initial down. And now the Fed cut will coincide with QE and loosening of financial conditions and all that sort of thing, so that now the upswing can actually occur, while a bunch of people think, no, the downswing is going to occur because when the Fed cuts rates, then bad things happen. What if the bad thing already happened? What if we're already in recession? What if the blood in the streets already occurred and that we're about to have a takeoff to all-time highs, while people are like, no, we should be short? Well, what happens when a bunch of people try to go short on a bullish move? You get short squeezes. So things might be actually, for financial markets, way better than we think. Terrible for the economy. Pretty bad for the economy. But maybe higher than we think. Cuppy over here from, I love Cuppy's news. Let me just go back 1 second. He says, if any of you follow any of the 493 in the SPX, there's a typo here, SPX, you know that we're in a nasty recession and it's rapidly accelerating. This is going to be the nastiest recession of our lives because QE will make it worse, and the only fix is time. I genuinely expect real GDP to go horribly negative, though the inflation will play tricks on most people. I don't know, Peter. I was going over the bottom 493 assets, the equal weighted ETFs, just to get a sense of how far away are a few of the assets really dragging the prices up for the indexes and the ETFs versus the lower half. And I'm not really seeing that number. I'm not really seeing the problem with the lower half. It's more like flat to slightly up, which is what I would expect in sort of like this middling growth experience. Plus, a bunch of these jobs are being lost because of AI.
Right.
Thousands and thousands and thousands and thousands of jobs being laid off with AI, but that money is still being reinvested within the economy with the expenditure for infrastructure, for the buying of the GPUs, for the setup of the AI systems, and new jobs are being created that are more, in a sense, productive. Jobs are being created that are more productive. So the question here is the unemployment rate going up because there's really a problem within the economy, or rather that net we're losing jobs, or is it that we actually have higher productivity and that's why we don't have the jobs and we actually have a whole new problem?
At first, it sounded like you were seeing something optimistic, that maybe the bottom is in, maybe things are not so bad, maybe the recession, we're already well into the recession. And now it sounds like you're saying there might be a whole new problem that we don't have any way of analyzing yet.
Well, I think it was Mark Andreessen who said this, that more people will need to be investors / traders as their job, which is something I've been saying now for a while. So thank Mark for stepping on my toes there.
But isn't it convenient that the investor is saying his job is secure? I mean,
yeah. Why wouldn't it be convenient for the people who see ahead of us, who have the money and make the decisions, for them to know what the future is? Yeah.
I don't know. It's self-serving.
If Steve Jobs
not going to come up.
Yeah. If Steve Jobs told me that in the future, you probably want to bet on the iPhone having, phones having this sort of feature, I'd be like, okay, let me bet on that, because why would he steer me wrong? It doesn't make any sense.
Look, I'm not.
This is not like Elon making rockets to go up to fake space. It's not like that. Not like that at all.
He knows. He knows. All right.
So it's fun. It's fun. It's interesting to be able to be in a situation where you're not just suffering the vicissitudes of what the government does. You can make money on it. And the best way of making money is to trade, not financial advice. Do your own research. It's to trade. You find a way of expressing your idea within the markets, and you protect yourself, your family, your friends, and your own mental sanity. Because then all of a sudden, what Donald Trump does, or what Jerome Powell does, helps you. It's good for you. All right, Peter. Anything else we should touch on before we let everyone go?
Well, look, I want to remind people that during After Hours, Tom discusses equities, dollar, Bitcoin, fiscal, and monetary policy. You can expect those macro perspectives every week here on After Hours. Like and subscribe to the channel. Did you hear about Oracle firing all those people and how they did it? I think it was Oracle.
Yeah, but it's unclear as to if this is actually a problem. Like,
well, I don't know if it's a problem. I just thought it was pretty. It's pretty dramatic to, like, you get an email going project updates, and then you get to the Zoom meeting.
AI is taking your job, okay? AI and robots are taking your job. You better, if you're sitting around and you're like, oh, not me, you're out of your freaking mind. You better make yourself obsolete right now and start your business or get a new job or whatever it is. Because if you're just sitting around, you don't know what's going on. What is it at Xbox, the video game company, and for Microsoft? People are getting laid off constantly because Satya Nadella is like, hey, we got to find money in the budget for AI infrastructure and expansion. And if you think Call of Duty is going to stop him from doing that, if you think your job is secure because I'm part of a large franchise of video games that makes $100 million, $1 billion a day, you're not making AI money. So clean up your CV, go start your side business, start trading, or DoorDash, because I don't know what you think is going to happen. AI and robots are coming for your job.
The drones are going to be delivering food. I don't know if you've seen those what do they call it? not prototypes, but when they test it out in the population.
Sure.
That's the word I'm looking for. But the drone flies up in the air, very high up, so you can barely hear it. So it's super quiet, and then it drops a zip line down with a device, and then drops your food right there within moments. People are saying
Brilliant.
it's really fantastic. So DoorDash may not be, and then you got Elon Musk getting rid of Uber drivers, and that's going to be. It's a wild
Peter,
world.
that's why trading is so important. Guys, you think we're building Traders Post over here as just like a nice to know tool. You need to be able to use these systems, learn how to trade, and make money in a way that's actually more reliable, because AI doesn't have to replace you. It can help you.
Right.
Traders Post is not just a nice to have, it's required. Peter, Traders Post is like, you've described this, the Iron Man suit of trading. It allows you to shoot missiles out of your hands and fly.
I don't think
And so
Iron Man does that, but yeah.
Yeah, he shoots like
No,
oh no, he does
one of
this.
these.
He does like this. Does that. Yeah. Yeah, no, all joking aside, I think trading is like going to be the top 3 gig economy job, because then you actually get to participate in what the AIs and the robots do when they take over your normal livelihood.
And that falls in line with what Mark Andreessen said, right? About being an investor. Trading,
That's
being a trader is like being an investor.
They're tokenizing houses now. They're like, oh, you can get 1/500th of a house. They tokenize it, and then you hold it, and then you're earning a little bit of money off of the rent in that place. Yeah. Guys, millennials, us and lower, we're not owning anything. The only thing we're going to own is one sliver of a thing. All right, so get your slivers. Start trading. Get your slivers. Because that's what the future
We're not going
is.
to own. We're not going to own our cars. Not going to own house. But we'll earn 0.001% on the Mona Lisa. All of us will own the Mona Lisa eventually,
and we'll be happy for it. All right, that's it. We'll be back next Friday with way more after hours. If you guys want to see us trading, you can join me and Mike Tuesday to Friday mornings, 9:30 a.m. Eastern Standard Time. On Tuesdays, we do office hours where you can get a deep dive into how to use Traders Post. And of course, Thursdays, we have Blueprint, where we create tools to help you trade better, or at least differently. Maybe not better, just differently. It never ends here at Traders Post, folks. But we wish you guys a great weekend. And as always, happy trading.